So now we are still on section 2 of this reading, and again, as a general point, in section 2 we are covering general points across all asset-backed securities, and we just talked about collateral cash flow. Now let's talk about credit enhancements. Why do you think we need credit enhancements for asset-backed securities? Yeah, with asset-backed securities, we have credit risk. So if a given issuer wants a certain rating, and let's say that the quality of the underlying collateral is not very good, can he do something to still get a relatively good credit rating? What he can do is credit enhancements. And this is an important element of asset-backed securities. So we'll spend a little time on this. Asset-backed securities are credit enhanced. That is, there must be support from somewhere to absorb a certain amount of defaults. In the example that we started this reading with, you had the company that was issuing loans to people who want to buy expensive home theater stuff. If people default, then what happens to the investors in the HAT issued securities? They would suffer. Now, the way we can protect those investors is through credit enhancement. Credit enhancement levels are determined relative to a specific rating desired for a security. So if we want a rating of, let's say, highest possible rating of A+, AAA, then there needs to be a very high degree of credit rating, credit enhancement. There are two types of credit enhancement structures, external and internal. We talked about these briefly in the previous reading on commercial mortgage-backed securities. Here we will get into the details. External credit enhancements come in the form of third-party guarantees that provide for first loss protection against losses up to a specified level. So in its simplistic form, essentially there is an insurance company that is insuring against losses. External credit enhancements include issuance by a monoline insurer. So this is just a type of insurer who is focused on insuring the collateral that you have. A guarantee by the seller of the assets. So what would this be in the example that we studied at the beginning of this reading? You had the seller. Who was the seller? So it was Quality Home Theatres. And who was the issuer? Issuer was HAT. This first point comes from an insurer, a regular insurer who focuses on this business. This second one, a guarantee by the seller of the asset. What do you think this means? This basically means that QHT is guaranteeing that HAT will make all its payments to the investors. What is the issue with this structure? The issue with this structure is something called a weak link, where what if the credit rating of QHT is BB or BBB? How much weight do you think investors will put in a guarantee from a BBB rated company? Not much. So if these guys are BBB and let's say this has an A rating, investors take basically the weak link. So when they try to rate this security, do you think they'll go with the higher of these two or the lower of these two? Lower. So actually QHT is actually not helping the cause. In fact, it is hurting the cause by trying to guarantee. So in general in life, if you want somebody else to offer you a guarantee, that other person better have a better credit rating than you. Okay. Similarly, a letter of credit. This typically comes from a bank, and there again, the value of that letter of credit depends on the rating of the bank. An investor will take the lower rating. So given this weak link issue, the most popular form of external enhancement is using a outside insurer. Okay. Now we'll spend a little more time on internal credit enhancements. The most common form of internal credit enhancements are reserve funds and senior subordinate structures. This statement has come out of the summary. The curriculum also has a third method which is not used as often, but it's the easiest to understand, which is over collateralization. Over collateralization simply means that if your collateral is worth 100 million and the bond classes that you issue have face value of say 30 million, 20 million and 20 million, what's the total value of your issue? 70. So will you feel comfortable if the collateral, as an investor, if the collateral is more than the total value over here? How does this make you comfortable? Because this means that you have a cushion of 30 to absorb potential defaults. Does this give credit enhancement? It does, and the method is called over collateralization. The second method is reserve funds. In its simplest form, you can think of the following: that let's say that you have issued securities worth 100. So there is another bond class that has face value of 30. So you've issued securities worth 100, and since you've issued securities worth 100, then let's say that the issuer has this reserve fund also, so a reserve fund of cash, which is going to be used in case there are some defaults. Okay, so that was the second method, the reserve funds. There is a little more detail on this in the curriculum, but simplistically you can just think of it as extra cash which offers internal enhancement. Okay, next, and probably the most important from a testability perspective, is the senior subordinate structures that I hope you are becoming comfortable with. How do you think this would work? How do you think the different structures that we've talked about, or structuring this issue, can help with credit enhancement? Yeah, so as you've seen before, if you have issued 100 million worth of securities, then having a structure like this where you have a senior bond class and then subordinate bond classes, how does this help with credit enhancement? You have redistributed credit risk. So which of these bond classes is the most credit enhanced? So through the structure you have enhanced the credit of A. So can you imagine that these different bond classes will have different ratings? The best rating will be for A and so on. Okay, so this is your simple structure. All right, so let's take that same structure that we just talked about. What's a possible issue with this rather simplistic scenario? Tausif? So let's say that you bought or invested in the senior bond. All right. Do you feel protected? Okay, now let's say that there are $3 million worth of defaults. Do you still feel protected? Yeah, but what's your worry? Actually, still your worry is that as defaults start happening, or let's say prepayments are happening, and if prepayments happen and this is retired, what has happened to your degree of protection? So your degree of protection goes down. So as at a larger level, if the face value or par value of your subordinate bonds is very low relative to the par value of senior bonds, then the level of protection is low. Okay, you can think of this as the size of the bodyguard. If you have a thin, scrawny bodyguard without much strength, then the level of protection is low. If you have a good fat bodyguard with essentially here, large par value amount, then the protection is more. Okay, that's one element. Now, even if you have, let's say, a medium-sized protection, as prepayments come in or as defaults happen, then what's happening to your degree of protection? That's going down. Okay, so with that in mind, let's understand what's going on, and let's understand one important piece of terminology. The terminology is something called subordinate interest. This is the percentage of mortgage balance of the subordinate class. So in our example, let's say that B and C are lumped together. The subordinate interest is 10%. Okay. Now, over time, if the subordinate interest goes down because of prepayments or defaults, if this goes down to just 2%, then you are walking on thin ice, in the sense that more prepayments or more defaults, and then immediately you are exposed. Okay. So, to deal with this problem, we have something called a shifting interest structure that I'll talk about. Let me just read what the curriculum says. For mortgage-related asset-backed securities and non-agency mortgage-backed securities, there is a concern that prepayments will erode the protection afforded by subordinate tranches after the deal closes. Okay, this is in line with what I have been saying. Okay, the next is a shifting interest structure is used to protect against a deterioration in the senior tranche's credit protection due to prepayments. And how does this work? By redistributing the prepayments disproportionately from the non-senior tranches to the senior tranches according to a specified schedule. Okay, so what does this mean? You've understood what subordinate interest means? That is the percentage of the total par value that is in the subordinate bond classes. In your very simplistic scenario, as prepayments come in or as defaults happen, what happens to the subordinate interest? It goes down. But if we set up something called a shifting interest structure, the interest structure here is really the subordinate interest structure. So what we try to do is prepayments come in, so those prepayments actually also reduce the senior, the principal associated, or so that money coming in is paying off the senior tranches also. If the senior tranches are being paid off, what we are trying to do is maintain the buffer. So as defaults happen or prepayments come up, rather than eating up the buffer, by taking some of the prepayments and assigning those prepayments to the senior tranche, what are we doing? We are trying to maintain the buffer. And a structure that tries to maintain at least some of that buffer is called shifting interest. Now, my advice to you is, this is a subset of a subset of a subset. What do I mean by that? What were we, just take a step back, what were we talking? We are talking about asset-backed securities. With asset-backed securities, we then say that we need credit protection. With credit protection, then we say for credit protection, there is the concept of credit enhancements. With credit enhancements, there is internal and external. With internal credit enhancements, there is a structured, one way of an internal enhancement is to have your structure, and then one aspect of that structure is the shifting interest. So how many layers of the onion did we have to peel to get to this? Okay, so given how many layers deep we went, my opinion is that on an exam, as long as you at least understand what shifting interest structure is, you are ahead of many people. But if you look at the curriculum and you look at questions at the back, they are detailed questions on shifting interest where you are given the structure and asked about how to deal with it. If you are on top of your studies and you feel diligent enough, then you attempt those questions, and now that you've understood the concept, hopefully it will be easy to do, and let me know if you have trouble. But at the very least, make sure that you understand the concept that I just explained.
Sir?
Yeah.
What you're saying is basically that this 10% stays constant over time.
No, the 10% doesn't necessarily stay constant. Actually, if we get into more detail, a schedule can be defined which tries to tell us that in year 1 we want maybe 10% protection. In year 2 maybe the schedule says that we can live with 8%. Obviously, as you get deeper into the life, you are more comfortable with less protection. Okay, so you don't need to maintain the 10%. The number can go down based on some sort of a schedule. And again, if you are totally excited about getting into the depth of this, then do the problems. Okay. Section D is call provisions. So call provision can be granted to a trustee, which means the trustee might have the right but not the obligation to call the instrument. Since I did not see this mentioned in the learning objectives, I'm not going to spend time on it. There are enough other places where you can be tested on call provisions. Okay, so now we begin this long sequence which will test our patience, but nevertheless we need to go through this. There are all kinds of different asset-backed securities, each with their own name, and the name comes from the underlying collateral. Okay, so just to set the context, if the underlying collateral is auto loans, then the name of the asset-backed security is auto loan-backed asset-backed securities. If the underlying is credit card receivables, then the name of the ABS is credit card loan-backed ABS, and so on. Okay, now let's get into these various categories. Home equity loans, the way you can think of this is as follows. Let's say you own a home and you go to the bank and you take out a loan with the home as collateral. Okay, as opposed to being an initial homeowner, but you now are the homeowner, you need a loan, you go to the bank and say my home is collateral, I need a loan. Why might you do that? With the home as collateral, you can get a lower rate. Okay, because for the bank there is the comfort that in case you don't pay, the bank has a lien or a right to take over the home if you default on your payment. So take a wild guess. Financial institutions, when they use those loans to create securitized products, what are those securitized products called? Yeah, home equity loan backed, asset-backed securities. Okay, so the collateral for a home equity loan is typically a first lien on residential property. These loans typically fail to satisfy the underwriting standards for inclusion in a loan pool of the agencies because of the borrower's impaired credit history or too high a payment to income ratio. So anyway, the loans we are talking about here are loans that are not backed by agencies. So is credit risk an issue? Yes. It's an issue. Typically, a home equity loan is used by a borrower to consolidate consumer debt using current home as collateral rather than to obtain funds to purchase a new home. Now, I have nothing against Americans, but here is a typical characteristic of Americans. They tend to spend a lot of money. So typically, if they earn $100, most of that $100 will be spent living in the best possible house, driving the best possible car, and top of the line TV and stereo system and all that. And to top it off, most of these things will be on a loan. The home will be on a mortgage, the car will be on a car loan, and various other, the home entertainment system will be on a loan, plus there'll be some credit card debt. Okay, so let's say that somehow this American family has now paid off the home. So what they can then do, now that the home is paid off, they can go take out another loan against the home and then use that relatively low cost loan to pay off the credit card and the car loan and the loan from the home entertainment company. What's the advantage of doing this? Advantage is they can lower the interest rate. Obviously, it is better to pay a 8% rate to the bank for a home equity loan rather than a 28% loan to MasterCard. Okay, so that's the logic. So home equity loans can be either closed-end or open-end. A closed-end loan means, okay, this family went and borrowed $50,000 and then that loan needs to be paid off, versus open-end means that it's like a line of credit. So the 50,000 loan, if 25,000 is paid off, then they can still utilize the, so anyway, they can keep borrowing against that limit. So it's just like a open end or rotating credit line. It's essentially like a credit line. Okay. Now just, I know this is tough, just follow with me. I am reading the summary and just explaining it. You need to pay attention and try to memorize these points. What the value that I will try and add is twofold. Okay, I know I'm just reading, but there is twofold value. One fold value is that things that are hard to understand, I'll explain. The other value is I'll also highlight what I think are the most important and most testable items. So what are we still talking about? We are in section 3, which is home equity loans. For all these different topics, the most important thing to understand is what are the cash flow and prepayment characteristics, especially what happens to the prepayment if interest rates go up or down. Okay, now let's go through this. The monthly cash flow for a home equity backed security backed by, well, let me read this again. The monthly cash flow for a home equity loan backed security backed by closed-end home equity loans consists of net interest, scheduled principal payments, and prepayments. You knew that already, right? So in general, when money comes in, it's either interest or principal that is scheduled or principal that is a prepayment. Several studies by Wall Street firms have found that the key difference between the prepayment behavior of HELS, what are HELS? Home equity loans, and traditional mortgages is the important role played by the credit characteristics of the borrower. So the core point is with a home equity loan, it's much more important to understand the characteristics, credit characteristics of the borrower. Moving along, studies suggest that borrower credit quality is the most important determinant of prepayments, with the sensitivity of refinancing to interest rates being greater the higher the borrower's credit rating. What this is saying is, if the borrower has a good credit rating, then the sensitivity to interest rate changes is high. If the borrower has bad credit rating, then the sensitivity to changes in interest rate is low. Why do you think, Harun? Why do you think that's the case? Yeah, so the bottom line is just need to think logically, and this is tougher for people in Pakistan than for people in America to relate to this. The idea is this. Let me just draw, in your regular mortgage-backed securities, there the relationship is very clear. When interest rates go down, people will refinance. Okay, not an issue. Over here, let's say that you have a poor credit rating. When you have a poor credit rating, is it easy for you to get another loan? No. So if the credit rating is of the borrower is low, then even rates going down does not impact prepayments to the holder of the asset-backed security. Why? Because if the credit rating of the original guy who took out the loan is bad, banks will not be willing to loan him another amount. Okay. On the other hand, if the credit rating of the guy who has taken out the home loan is good, then will he be able to easily refinance if rates go down? Yes. Now, how does that impact your analysis as the holder or the investor in asset-backed security that is backed by home equity loans? You will study the pool of loans and you will try and understand the credit characteristic of the people who have taken out those original loans. If you notice that in general the credit quality is good, which is typically because these loans are from people in affluent areas, then you can say that prepayment risk is relatively high. Okay, but credit risk is relatively low. Okay, that's the core point here. That sensitivity to interest rate has another dimension. That additional dimension is the credit rating of the borrowers. The prospectus of an home equity loan offering considers a base case prepayment assumption regarding the initial speed and the amount of time until the collateral is expected to season. Does this look familiar? So this is like the CPR and the 100% PSA benchmark. A prospectus prepayment curve is a multiple of the base case prepayments assumed in the prospectus, i.e. the base case is equal to 1000 PPC. Now here is the kicker over here. We have gone through this long-winded exercise in mortgage-backed securities where we had the concept of SMM, we had the concept of CPR, and then we had the concept of 100 PSA where we said over 30 months we get to 6%. So this was 100 PSA. Now just to make our life interesting, the same concept applies in home equity loans, but the terminology and the calculations are different. Okay, and if you really want to know the terminology and the calculations, instead of 100 PSA, we say 100 PPC. And the calculations are given in the curriculum and probably in Schweser. Now, I'd venture to guess that if the CFA Institute wants to test you on this stuff, they will test you on the much bigger and much more likely scenario of PSA and CPR and so on. Okay. On this, if you are tested, you will be tested on the core concept that the prepayments depend not only on interest rate but also on the credit quality. If you want to be super diligent, then you can go learn this terminology and the and the formulas that are specific to this. To deal with prepayments, do you think we can do tranching similar to mortgage-backed securities? There is a lot of detail, but the concept over here also just boils down to the fact that you can do prepayment tranching the way we do with mortgage-backed securities. Okay, next, section 4, manufactured housing-backed securities. What do you think this means? So in America, people can buy manufactured houses. Okay, you can actually see these big houses going on large trucks, which are pre-manufactured, and then they are gone. They are placed wherever they need to be placed. So they are relatively inexpensive, and people with relatively low incomes buy those manufactured houses. So what do you think is a manufactured housing backed security? It is securities that are backed by loans for manufactured houses. Okay, so backed by loans for manufactured homes. Okay, now here, when interest rates change, prepayments don't happen. So interest rates go down, prepayments don't happen. Why? So generally it is for several reasons that are given here, but the core point to remember is prepayment is not an issue with these securities. One, the loans are typically small, relative, like an average house might cost between $200,000 and $300,000. A manufactured house might cost less than an expensive car, so it might be $50,000 to $60,000. So the benefit of refinancing is relatively low. The second point is that typically with manufactured housing, the depreciation initially happens very fast. So the value of the house comes down a lot in the first 2-3 years. So that makes refinancing difficult because the value of the collateral has gone down. And the borrowers tend to be low income people with low credit ratings, so it is hard for them to get refinancing. So all this means that investors in those securities, which are backed by manufactured housing backed securities, have other issues like credit risk and so on to worry about, but they don't really need to worry about prepayment risk. Okay. There is this whole segment in the curriculum on residential mortgage-backed sector outside the United States, and they talked about the UK and Australia and so on, but there is no mention of this in the learning objectives. So I am skipping through this. If you love this material, you can read it after the exam. Okay. Auto loan backed securities. And auto loan backed securities are issued by financial subsidiaries of auto manufacturers, commercial banks, and independent finance companies, and small financial institutions specializing in auto loans. So, no rocket science there. The cash flow for auto loan backed securities consists of regularly scheduled monthly loan payments, okay, and prepayments. Does this look familiar? So you did not need the curriculum to tell you these 2 points. You knew these already. Prepayments on auto loans are not sensitive to interest rates. So this is a very important point. Why? Good. So one question, the big reason is the loan amount is small. So loan amount is small, so the benefit of refinancing is not as much. The other reason is cars tend to depreciate very fast. Okay, so your brand new BMW that you bought for $50,000, the moment you drive it out of the dealer, you lose a few $1,000s, and then a couple of years later, you lose a few more $1,000. So when you try to refinance it, obviously the value of the collateral, which is that not so shiny BMW, is much less. Okay, so for the investor in these securities which are backed by auto loans, for them prepayment is not much of an issue. So prepayments on auto loan backed securities are measured in terms of absolute prepayment speed, which also interestingly is called ABS, which measures monthly prepayments relative to original collateral amount. Again, just like we have SMM, CPR, and 100 PSA benchmark, there is this entire set of terminology that is specific to auto loan backed securities. And again, I am taking a calculated risk by saying that the probability of your being tested on the details of that setup are very low. So if you are to remember the one core point on auto loan backed securities, what's that core point? That prepayments are not sensitive to interest rates. Okay. Continuing with the long list, student loan backed securities called slabs are asset-backed securities backed by student loans. Okay, the student loans most commonly securitized are those that are made under the Federal Family Education Loan Program, whereby the government makes loans to students via private lenders and the government guaranteeing up to 98% of the principal plus accrued interest. Okay, why do you think this category is one that is mostly used as the pool in the securitization process? Because they are backed by the government, so somebody who invests in those securities has the comfort that in case there are defaults, the government will chip in. So that increases the credit quality of the instruments that are issued. Okay, alternative loans and student loans that are not part of the government guarantee program are basically consumer loans. Student loans involve 3 periods with respect to the borrower's payment. So when I was a student, I had a loan. When I was in college, I did not need to make any payments. Then there was a grace period of 1 year, which said that 1 year after coming out of college, I don't need to make any payments. And then after that, over the next 15 years, there was a monthly payment. The payments typically, prepayments typically occur due to default or loan consolidation. Now, again, let me see if you got this point. How can we have a prepayment due to default? Yeah, if a student starts defaulting, then given that there is a government backing, the government pays, and then the holder of the security gets the money faster. Issuers of slabs include Sallie Mae and other traditional corporate entities. Another key attribute over here is student loans typically offer a floating rate, okay, either based on T-bills but more commonly based on LIBOR. Okay, with prepayments there is also a contraction risk, and another point that has been missed here, but I'll just point this out, which happened in my case and in general it happens. When a student starts paying off loans and let's say a relatively small amount of the principal remains outstanding, then what most students who maybe 5 years after college have a much better salary, what are they likely to do? Keep paying the $150 per month or just pay off the loan? Pay off the loan. So that happens with most students. So what happens to the investor in the ABS? He gets his money back faster, so contraction risk. Okay. SBA loan-backed securities. Most SBA, so what's SBA? Small Business Association. So what's happening here? They are entities that are giving loans to small businesses to support those small businesses. Most SBA loans are variable rate loans where the reference rate is the prime rate. What's the prime rate? This is the interbank rate, the LIBOR or the CIBOR, depending on the country you are in. So most, even if you can think of it over here, when loans are given out to small companies, the loan is CIBOR plus a spread. So typically in this environment, the loan rate is CIBOR plus, or whatever the prime rate is, plus a spread. Voluntary prepayments can be made by small business association borrower without any penalty. Okay, so there is a contraction risk, and again, since there is a contraction risk, we can measure the prepayment rate using CPR. Factors contributing to the prepayment speed are the maturity of the loan. So it has been found that the fastest speeds on SBA loans and pools occur for shorter maturities. So typically loans that are for relatively shorter periods tend to be paid off faster. And the purpose of the loan, the elaboration in the curriculum on this is, when a loan is taken out, loans in a small business can broadly speaking be taken out for two reasons, either for working capital or for fixed assets. If the loan is for working capital, it tends to be paid out faster. If the loan is for fixed assets, then the period will be longer. Okay, now the final segment on this class, and then we'll do CDOs in the next segment. So credit card receivable backed securities, we've touched these earlier. What are the core points here? Credit card receivable backed securities are backed by credit card receivables for credit cards issued by banks, retailers, and travel and entertainment companies. Okay. For a pool of credit card receivables, the cash flow consists of finance charges collected, fees, and principals. Okay, so credit card companies collect all the, what are these finance charges? This is the interest that is collected by credit card companies. So all the collections that they make, the fees that they charge, that becomes the pool for the securities that are issued. The principal repayment of a credit card receivable backed security is not amortized. So this is non-amortizing collateral. Instead, during the lockout period, what's the lockout period? Yeah, during the lockout period, are the actual credit card owners allowed to make payments back to the company? They can. The lockout is in terms of the holder of the ABS not getting the prepayment. So in the lockout period, the principal payments made by credit card borrowers are retained by the trustee. This is the entity that has issued the securities, and reinvested in additional receivables, so additional credit card loans. And after the lockout period, which is called the principal amortization period, the principal received by the trustee is no longer reinvested but paid to the investor. So this is the principal being paid. So this helps reduce the contraction risk. There are three amortization structures that have been used in credit card receivables backed securities. One is a pass-through structure. What do you think this means? So in this, after the lockout period, as payments come through, they just pass through and flow through to the investor. So if all credit card holders just decide to pay off all their outstanding balance, then the security will be paid off and will be finished. The other two are controlled amortization structure and bullet payment structure, which we will talk about. Okay, so let's do this. To assess the performance of, now imagine you are an investor in credit card receivables in the ABS. So what do you think you need to worry about? When you are investing in this security which is backed by credit card loans or receivables, what do you worry about? And the answer is given here. You clearly worry about credit risk. So what are the specific metrics that you look at? To assess the performance of the portfolio of credit card receivables and the ability of the issuer to meet its interest obligations and repay principal as scheduled, an investor must analyze the gross portfolio yield. What do you think this means? Okay, so this simply means this gross portfolio yield simplistically is how much interest payments or total payments are being collected by the credit card company relative to the outstanding balance. So the higher the better. The next is the net portfolio yield, which is simply gross portfolio yield minus any charges and delinquencies. What are delinquencies? This is where it's basically write-offs. Okay, so you look at these metrics. Since for credit card receivables backed securities, the concept of prepayment does not apply, participants look at monthly payment rate. What do you think monthly payment rate means? It's the monthly payments, which includes interest, finance charges, principal. So the total money coming into the credit card company, okay, as a percentage of debt outstanding. What will make you comfortable? Okay, a high MPR or a low MPR? Yeah, a high MPR implies that money is coming in relative to the outstanding amount. If this ratio becomes too low, then what's the risk? Risk of delinquencies, and delinquencies would imply credit risk for the holder of the ABS. The MPR for credit card receivables backed securities is important because if it reaches an extremely low level, there is a chance that there will be extension risk, okay, with respect to the principal payments. And if MPR is very low, there is a chance that there will not be sufficient cash flow to pay off principal, which means credit risk, which can trigger early amortization. So if there are any credit enhancements or so on, money can come in sooner and the issues will be retired sooner.